Hey guys, I'm the Newb investor. Today we'll be screening Visa through our three metrics to see whether the stock is trading at overvalued, fair, or discounted prices. Personally, I think this is one of those stocks to own and hold. So I recently just bought it at an average price of 199.15, and here's why. But first, I want to address an anomaly. If you look closely at their PEs from Yahoo Finances and Google's, there's a difference in PE. But I think Yahoo Finances is more accurate. So I think in this video, I'll just be using two PEs. The lower PE of 33.14 is Visa from Yahoo Finance, which I think is more accurate, and the higher PE of 39.79, which is Google's. Visa is currently trading at 200.29 with the highest price of 252.67. That's 20.73% from the highs. Its current market cap is 419.97 billion with PE ratio of 39.79 from Google and 33.18 from Yahoo Finance. We'll use two PEs when screening this. It gives out an annual dividend of $1.5, a yield of 0.75% of the current price. Looking at their payout ratio, it is safe at only a quarter of their earnings. I recently uploaded a video why PayPal stock fell 60% from the highs, and here's why. Comparing the two credit services industry stocks based from Finviz screener, the yields of PayPal are only half of Visa's and MasterCard's. So PayPal trading with the same PE as them would simply mean the stock is overvalued based from their yields. You were paying a premium for PayPal when it was trading at 40 PEs, which was a multiple for their revenue growth. But since then, investors felt that their growth would be lesser as they have also expressed in their guidance. So investors are selling to offset the multiple for revenue growth they had previously used for the stock. Anyway, if you haven't watched my video on why stocks trade at different PE, simply click that link on the description box below. Let's go on with our metrics. First metric, we want an EPS multiple lower than 3. It is 7.89 when using Google's PE and 5.49 when using Yahoo Finance's PE. We get this multiple by dividing the current PE by the EPS. Why do I do this? This is how I measure how much I'm paying for a stock in relation to their current earnings. Are they buying back enough shares for their EPS to catch up with their PEs? This also tells me whether their income is in good and healthy proportion with their outstanding shares. I've included the EPS history here to see if it is increasing or there's an anomaly that needs to be considered. OSN here is outstanding number of shares, decreasing, which is good. Going back to our multiple, it is expensive as we are paying 5 times, 6 times, 7 times their current earnings, but is it worth buying? Let's look at our second metric. Second metric, we want to pay $1 or less for 1% of the money they're making. This is based on the lowest yield of both the net income and free cash flow yields from the current year and the averages of 5 and 10 years. The more data the better, but in this video we'll only be using 5 years of data just to show you our process. Looking at the table, this is the revenue breakdown, the costs and expenses, and the income they get from those revenues. I'll show you the relationship of the sales. In 2021, they spent $0.73 billion in COGS to make a revenue of $24.105 billion. That's 3.03% of the revenues. You get the point. Why do I do this? This is how I measure how much I'm paying for a stock in relation to their yields. I've included the costs and expenses to have a sense of how much they can juggle these expenses. Why do I include the net income and not just the free cash flow? I thought net income is also important as the EPS is based on it and not on the free cash flow. Why do I take the lowest value? I take the lowest value to have a baseline for our assumptions as we don't want to pay at a higher PE. I've included here the revenue growth for the stock from 5 years because the years of the stock would stay the same even at a loss of revenue. My second metric does not account for the loss of revenues. So it is important to know that the company is maintaining or at least retaining their current revenues. From the 4 highlighted values, we take the lowest to divide our current PE. In this case, it's 47.97. And we'd get a discount of 0.83 using Google's PE and 0.69 with Yahoo Finances. Based from both PE, I think it is safe to say that the stock is trading at a discount at these prices, as we are paying for less than $1 for 1% of their yields. Third metric is historical PE. I have here two historical data. One I took from Guru Focus, which is readily available, and one I took from Macro Trends, where I manually took the PE from a range of consolidation. You'd see here the lows and the highs of PEs it traded before, and the number of quarters I took the PE from. We'd only use the lowest average PE of the two to divide the current PE, and we'd get our discount of 1.21 for Google's and 1.01 for Yahoo Finance's. I think it is safe to say that the PE it currently trades at right now is around the historical PEs. To conclude, the stock is trading at a discount based from my second and third metric. I just recently bought the stock, but I think I still reviewed and screen it like any other stocks. No biases, just my humble and honest opinion. Should you pay premium? I think no, as their revenue is not growing like 20% and above. I only do multiples for stocks potentially growing 20% at one point in time. My entry PEs would be 32, 34, 36, based from historical PE and a little margin of safety. I think the fair value is around $240 to $290, a 15 to 30% upside from the current prices. It is when we multiply the lowest yield in our second metric of 47.97 with the current EPS of 5.04 and 6.04 of Google's and Yahoo Finance's respectively. I bought at 199 because I thought Yahoo Finance's data was more accurate, but I'd happily buy again below 180. Looking at charts, it made very little progress since the COVID boom, yet the revenue grew. That's when I knew something is up with the stock. I think this is a better play than PayPal and MasterCards. Let me know if you want me to do a side-by-side comparison of the three stocks. Just comment down below. This three metric I use is designed to determine the best PE to buy a particular stock, as I believe PE is the price we pay for in a company. This is my process of screening stocks to buy at what PE by looking purely at the company's financials and none of their fundamentals. If you like to invest in these companies, I'd advise you to look at their fundamentals, their charts, and more of their financial data and metrics like long-term debt, some important financial ratio, etc. As always, do your own research.